We're here to talk about the Silicon Valley real estate market for the week ending October the 10th at 11:59. These are the key chapters we're going to be going over in order. There's timestamps in the YouTube description below, so you can jump right to the section you find most interesting. Let's get into the first data slide. Here's a summary of the key indicators, in my opinion. Inventory. You can see inventory is exactly normal. We had a little bit of a surplus of inventory, which was favoring a buyer 13 weeks ago. But inventory became normal basically 11 weeks ago and has been fairly normal ever since. Now, looking at offers have actually been improving. We were right on the blue line, which is the least number of offers you'd expect. And we got a little bit of error here from 6 weeks ago to last week. But look at the differential this week. Instead of going down like we normally do in a cool marketplace, we actually went up. We're sort of following the normal trend, which is one more week of increased offers before we turn around and come back down. Now, these aren't the highest offers because obviously the gray line was higher over here, but there's a recovery from the decrease in the number of offers. But we're still missing offers. We're still missing about 13.5% of the number of offers you'd expect to have for this time of the year. Number of closed transactions, it takes 5, 6 weeks to close a transaction in a slower marketplace, and therefore this is lagging behind and has not improved yet. It's sitting at about 83% of the normal level of transactions, but it's right on the blue line. Now, the days of unsold inventory, which is the ratio between the inventory and the number of offers, is exactly normal, 102%. I mean, you can't get closer than that. Normally, you're at 41.7 days. You're now at 42.4 days. That's 7/10 of a day. It's less than a full day differential. No one's going to notice that in the marketplace. Last week, I also believe it was less than 1 day differential between what you'd expect and what we were actually at. Marketing time, look at this huge improvement. You were way up here setting unexpectedly high marketing times. We were at 33 days. And in a time of the year when the marketing time slightly increases, we've actually improved down to 28 days, and we're now getting close to normal. We're only 12% slower than normal. What does that mean in terms of days? It's currently taking 28 days or 4 weeks to sell 3 out of 4 homes that are successful in selling. This metric does not include those sellers that are not successful, that try that but do not succeed. We're typically at 28 days. So you can see you're 3 days longer, half a week longer than normal for 3 out of 4 sellers to sell. Look at the price reductions. We had been taking more price reductions than typical, but a little bit less than the most you'd expect. And now we're halfway in between the normal, the gray line, and the least you'd expect. What does that mean in terms of price reductions? It means that on average, the sellers are taking a 1.3% price reduction, which is actually 41% greater than it normally is. Price reductions are fairly small in Silicon Valley, mostly because sellers and their listing agents do a lot of homework before they put their house on the marketplace and put the house on the market at a price that they think the property will sell at, and therefore the property sells without a price reduction. And then overbids, which is not a leading indicator. In fact, it's a lagging indicator because you need to have the sale price. So that means you need to have escrows closed. Look at the improvement the last several weeks, about the last 4 weeks. It's really been coming back up. It's now normal. The normal amount of overbidding is this gray number down here, 4.8%. What did we hit? We hit 4.8%. We're actually having more overbidding at 4.8% on average than we did just 13 weeks ago when we were only at 4.2%. And 13 weeks ago, you were expecting 7%. So you went from a 3% deficit on the overbidding, so 3% less overbidding than you'd normally anticipate, to exactly normal. We're improving on the bid in buyers. So the buyers are feeling more need to compete with their offer in order to secure a property in the last couple weeks. Now let's look long term. This is going back all the way to January 1st, 2015. We're looking at the 3 key indicators. The first one is the purple inventory, and these numbers are right on top of one another. I think purple was 0.1% lower than the inventory, but they're basically just over 100% on inventory and just over 100% on days of unsold inventory. But let's talk about inventory only. You can see inventory, we had a huge surplus basically most of this year. It peaked at the beginning, a couple weeks into second quarter, and then it took a quarter to come down. And basically, for most of third quarter, we've had essentially normal inventory. We actually got below the normal level of inventory a couple times. This is the Labor Day drop. The reason Labor Day drops is that it gets averaged out between 2 weeks when you're looking at the 10-year average. And in the given year, it's only 1 week. So you have this dip, but you basically have normal level of inventory. Moving on to offers. Here you can see that offers are down here somewhere around 86% of the number of offers you'd expect. That is actually higher than we have been for almost the entire time since July 1st of 2022. Basically, coming down out of the price correction of 2022. You can see you came down and you've been down at the 30% missing, 20% missing. Now most of this was at 20% missing, maybe a little bit better because it's been oscillating. And now you're only missing 15% of the marketplace. So a huge improvement there, but still missing. And again, you can go back and look. You almost have to get back to pandemic levels to be getting to this level. Now, yes, right after the pandemic, there was a huge surplus, but we're not having the shortage that we were having for the last 3 years. And then the last one is the days of unsold inventory, the gray line, and that is completely back to normal. You can see that it got up to 170% earlier this year, which was a record, except for the shelter-in-place pandemic spike, which is artificial, and it's been coming down. It's basically a nice steep peak in a mountain. Now we're going to look at Silicon Valley overall. So this is 3 counties: Santa Clara, San Mateo, and Alameda County, all in a blender. What are they doing as far as inventory? The gray line is your 10-year median. The red line is the least inventory you'd expect based on the past 10 years. And the blue line is the most inventory you'd expect based on the past 10 years. And you can really see we started off the year with a shortage. We clearly and quickly got it back to normal. We all within 1 quarter, we got up to a surplus with the most that you'd expect. We spent second quarter along that most line. And then in half of third quarter, we came back down to normal. And basically the second half of third quarter and now into fourth quarter, we've been more or less tracing the normal level of inventory you'd expect. This is on a percentage basis. So you can see right here, just over 100% of the inventory you'd expect. This is doing the same thing in offers. Look at this sharp departure from the blue line. You might argue that it's following the gray line, and then if that's what it's doing, you might have one more week of up, and then it should start coming back down again. And that's what I would anticipate doing. But this is basically the rebound we're seeing. And this is baked into the 10-year data. So there's a lot of people saying that this current rebound is due to the drop in interest rates. Well, first off, I would say it started way back here halfway through third quarter, which is before the interest rates dropped, and then it's been continuing up. If you look, it's sort of the same place that the normal market happens. So this is basically the normal behavior. In order for interest rates to impact, it would have to continue significantly past next week and catch up to the gray line. Time will tell if that happens. Here's offers on a percentage basis. You can see you're about 88% of the offers you'd expect. I think the number was 86.5%, but right in that ballpark. Here's your days of unsold inventory, almost exactly normal. You can see we've rolled over and we're coming down. Now, remember, on days of unsold inventory, a decreasing number is an improving marketplace. You're turning over more rapidly. Here it is on the percentage basis. You can see how rapidly we've been improving, coming back towards the normal marketplace. It may turn around and bounce right here at 100%. Again, only time will tell. Here's looking at marketing time. Look at this. This has been climbing. And I want to point this out again. It's been a while, I think, since I pointed this out. Look at this horizontal shift. Normally, you shift vertically up and down, but the peak happened a half a quarter early here. The bottom happened a whole quarter early, and now we're sitting here and improving at decreasing marketing time significantly from something like 35 days down to something like 28 days at a time when marketing time normally is increasing. So the time on the market for 3 out of 4 sellers is clearly improving. Sellers are spending less time waiting for that offer to come in the door. Here's on a percentage basis. You can see that it's just been a seesaw. We're really hot midway through first quarter. Then we got really slow at the end of third quarter. And now we've been falling off this cliff again, improving, getting hotter and hotter. Here's ask price reductions. Now, this is my metric, the one I like. And what it's doing is it's looking at the sellers that are taking the largest 10 percentile. So this is the 90th percentile price reductions. How large are they? And they're basically at 14%. You can see that they're improving, decreasing from a couple weeks ago when they were basically at 16%. This is on a percentage basis. So here's the improvement you're seeing on a percentage basis. You're still taking larger price reductions than you'd expected, almost a little over 20% more. Actually, it's about 22% more than price reductions than you would expect as far as magnitude. Now, those that prefer, here's the average. That 14% drop turns out to be about 1.3% when you look at the average. And that's because the vast majority of the sellers do no price reductions whatsoever. They price their home correctly, put it on the marketplace, and they sell. Here's on a percentage basis. You can see you're coming back up towards normal marketplace. You're sort of in the normal range according to my color coding. Here's the frequency of those price reductions. So how common is it? Less than 1 in 5 sellers are taking a price reduction right now. Basically, it's 18%. So 18% of the sellers are taking price reductions, which is getting pretty close to the normal level. It's still a little more than normal, but again, look at how much it's dropped in the last 3 or 4 weeks. And it's, dropped slightly during third quarter, but then you get to about 4 weeks ago and you have this marked cliff coming down where the price reductions, this is the number of sellers. So how common is it on? So you've dropped from basically 21% to 18%. So 3% of the marketplace has stopped taking price reductions. That 3% may not sound like a lot, but it was 1 in 7 before, and now it's 1 in 6. That kind of numbers are how dramatic it is. It's a 3% reduction in the number of sellers out of 100%. Here's on a frequency basis, so you can see it's still a little bit more frequent than normal, but coming back down towards the gray line down here, which would be 100%, which would be exactly normal. And the normal is based on the 10 years. Here's the median overbidding. So this is what buyers are doing. Now the median is only 1.5%. The average was up here at 4%, and that's because a few people spending 10, 20, 25% over ask price, which does happen, which we'll see later in the presentation, pulls up your average, but your median stays low. So your median's 1.5%. Half the buyers are paying more than 101.5%, and half the buyers are paying less than 101% of the seller's ask price at the time the offer is accepted. And that's important because we have talked about Alameda County, where sellers have been not coming on the marketplace, misreading the marketplace, staying around for long enough to take a price reduction, but then overshooting where the market actually is, and then the buyers coming in. Here is compared to typical, so we were dead on typical because this is back to the average overbidding. So the average overbidding is 4%, and that's what you'd expect. The frequency of overbidding, almost 60% of the sellers are getting more than their asking price. Look at this turnaround the last several weeks. Again, it's climbing at a time when the market's normally going down. So instead of the buyers feeling less competition like they normally do based on the gray line, they're actually feeling more competition as indicated by their behavior on the purple line. Here it is on a percentage basis. This is the frequency. So it's only 90% of the sellers that normally would get an overbid are getting an overbid now. So 10% fewer sellers. Here's a pricing model for you. This one way of doing it is this 11.4%, but that's getting pretty unrealistic because you have this big disparity here as well as another big disparity here. So I think it's closer to we had 12.1% increase for 7.5 years, and then 3.5 years here at basically 0% appreciation. Or you could put in a little bit of a dip, but I'm not. Yes, there was definitely a dip in 2022, but we recovered it pretty quickly in 2023. So I'm sort of ignoring that little short episode. Here's sort of a summary of the heat map for Silicon Valley. You're starting off over here on the green side with the compared to the 10-year normal. So normally here, if you're having blue, it's a cooler marketplace than normal. And so where are you blue? You're blue in offers, and that's really about it. You're pretty much, and you may be blue here in the amount of overbidding, but that's about to change, it appears. But overall, I would say it's pretty mixed. So you're sort of having a typical year. If you come over and look at the actual raw numbers here, you have a lot of red, and red indicates a seller's marketplace. So this would tend to indicate that even though the market is still sort of a balanced marketplace for Silicon Valley, it's still a fast-paced market. So Silicon Valley really tends to be a fast-paced marketplace. And then the deep orange are lagging indicators because you need sale price, and then you have appreciation and sold price. This is the heat maps for Silicon Valley. If you have a red area like you do in the Bay Cities area of San Mateo County, that indicates a less inventory than normal. A blue area over here on the coast indicates more inventory than normal. The bulk of Silicon Valley is white in color, which basically says you have normal levels of inventory. Moving on to offers accepted during the past 5 weeks, clearly a blue tint to the entire valley. So that indicates a lack of offers across the valley compared to what you'd expect based on the previous 10 years. Now, granted, at least a year and a half of that after the pandemic, just shy of 2 full years, was more offers accepted than normal, but that's only 2 out of 10 years. So you have a lack of offers to some degree. This is the days of unsold inventory compared to the 10-year median. This is the speed of the marketplace. So are you faster or slower than normal? Faster than normal here in Redwood City and the Bay Cities, slower than normal in Daly City area. Most of the valley is absolutely normal. So you're having the normal rate of sales. The speed of the marketplace, the turnover rate is fairly normal. Now you're looking at what are the raw counts. And with the exception of the Far East Bay, Silicon Valley is hot. So, yes, you have a lack of offers compared to what you'd expect, but you also have a fast turnover pace. What are we talking about? We're talking about we'd sell out everything in 36 days in Santa Clara County, 39 days in San Mateo County, and Alameda County is 50 days. But if you look at Alameda County, a lot of those days are at 30, i.e. Fremont, Hayward, San Leandro, Berkeley, and Alameda. Then you have Oakland at 69 days, but then you have the two far east areas in Pleasanton, Castro Valley, Dublin, and Livermore, where you're at 150 days almost to sell your existing inventory. So that's why you're saturated blue in those areas. It's a very slow marketplace. Marketing time, how long does it take 3 out of 4 sellers? Sort of interesting here in Pleasanton, even though you were at 60 days to sell, they're selling 3/4 of the sellers are selling in 80% of the time that they normally do. So you have to pay attention to whether you're talking about the speed of the marketing time relative to normal or actual absolute marketing time. So marketing time compared to normal, faster in the Bay Cities, faster in Saratoga, Los Gatos, and actually faster in Pleasanton. Marketing time itself, notice how Pleasanton doesn't show up. So what is Pleasanton's marketing time? It's 30 days. That's sort of a balanced marketplace. It's right there in the white zone. But so where are you actually fast? Not compared to where you normally are, but just absolute scale. Are you fast? You're fast in the Bay Cities. You're fast in Sunnyvale, Cupertino, fast in Palo Alto, and also Los Altos, as well as Saratoga, Los Gatos. So sort of the West Peninsula area is a fast-paced marketplace, basically being under 17 days, and the rest of the valley is sort of a balanced marketplace, which is between 3 and 6 weeks. This is your ask price reduction, and again, this is compared to normal. So Blue would be more price reductions than normal. So you can see that a lot of the valley is taking greater price reductions than they typically do. But you also have hotspots. Saratoga, Las Gatos, the coast, and the Bay Cities are taking less price reductions than they normally do. Here's the magnitude. This is the average. So this is just raw numbers. So how large are the price reductions? They're running right around well, just over 1%. You got 1.3% for Silicon Valley overall, 1.1% in Santa Clara County, 1.1% in San Mateo, and 1.5% in Alameda County. So Alameda County is clearly taking larger price reductions, but you can sort of see a blue tint to the whole Silicon Valley. So slightly larger price reductions than they normally do. This is how common are the price reductions. So now here you have some balance. You have Saratoga, Las Gatos. They're only taking 2/3 of the price reductions they normally do, and this is frequency. But then you go up to Hayward, and they're taking double the price reductions on the frequency basis than they normally do. So twice as common as it normally is in Hayward. Then you're actually looking at what are the price reductions. So if you go to Hayward, the frequency, 27% of the sellers are taking price reductions. That means since it's twice as much as normal, that means in a normal marketplace, only 13% or 1 in 7 sellers is doing a price reduction in Hayward. You can clearly see there's some hot spots like Cupertino, Sunnyvale, and there's also some cool spots. If I was to guess, the coast is one of the coolest ones at 30% of the sellers are doing a price reduction. Castro Valley's at 31.5%. So that looks like it's the biggest, most frequent price reduction. So not even 1 in 3 sellers is doing a price reduction, and that's the most frequent price reductions in the micro market areas. Overbidding. So now we're going away from the sellers and looking at buyers. Where are buyers feeling pressure? Sort of in the central part of Santa Clara County, or at least the western central part, basically west of 880 up into maybe a little bit into San Mateo County. People are feeling the pressure of overbidding. The most overbidding is up here on the island and the city of Berkeley in the East Bay. But you can see the East Foothill range up into the East Bay is pretty blue in color, which means there's less overbidding than normal. Here's the buyer's overbid magnitude on average. So instead of comparing it to normal, just what are the numbers? And you can see that even though up here was blue on the previous compared to normal, it's a slight shade of pink. So people are still overbidding, even though it's less overbidding than normal. But again, you can see the concentration sort of west of 880, west and north of 880 is sort of where a lot of the overbidding is occurring. Here's the frequency of that overbidding. So where is it most common? You can see that it's less common than it normally is. So if the magnitude is still okay, but it's not as common, those that are overbidding are still overbidding aggressively. So you either have overbidding or you don't have overbidding. But here is the frequency of overbidding, and it's 89% in Alameda County, so 11% less overbidding than it normally is. This is the frequency of the buyers, so just raw count, so 11% less, but look at these numbers. They're still 50% are getting more than the asking price. So maybe it's normally 57% instead of 52%. That's the kind of, that would be a 10% difference. But anyway, you can see the hot spots again are west of 880, or the hottest spots are west of 880. Here's the long-term appreciation. Here are sort of the outlying commute areas that are still reasonably close. So people are willing to commute a little bit further, but not as far as they were during the peak of the pandemic, where Livermore was lit up in nice big red. This is the sold price. So this is simply affordability. So that's also part of why people are coming out to these areas here that were read in the previous slide, is affordability. And instead of following the median price only, which is the middle number down the columns, I add in the cheapest 10% on the left and the most expensive 90% on the right. So you have a price range. So 40% of the homes are between the number on the left and the number in the middle, and 40% of the homes are between the number in the middle and the number on the right, or 80% are between the outside extremes. So you quickly can see what ranges of home, what geographical areas would have a home potentially for you based on your price range. So these are the summary of what we just went over. You can see all the different conditions. Your micromarket Santa Clara County here, San Mateo in the middle, and Alameda County in the bottom. You can read across and see what kind of conditions you are based on the market area that you're looking in. We have been talking about the Silicon Valley real estate market. We will continue talking more about the Silicon Valley real estate marketplace. Then we'll talk about the Greater Bay Area, 13 counties and 5 regions. The blue is my YouTube archive URL, or you can type in the shorter green root URL in there if you don't mind secondary links. To join the presentation live Saturday morning at 9 a.m., you type in the green root URL plus the year 2025 and you get there. If you don't like secondary links, you type in the Zoom meeting, which is here for you, and the passcode is built into the link. Or if it asks for you separately, it's right there for you, the 2JDW2F. And if you want the handout, is the green root URL, H for handout, 2025, 10 for October, and 11 for today's date, Saturday. And here's the drive link from last week. Obviously, I don't have the drive link for this week. I'm Richard Calhoun, real estate broker with Creekside Realty, working with buyers and sellers here in Silicon Valley. My email and phone number is there for you if you have any questions regarding statistics and or real estate in general. I'd be happy to talk to you about your real estate needs. Now we're looking at Silicon Valley, but we're breaking it up into 3 counties. We have Santa Clara County in the blue, Alameda County in the gray, and San Mateo County in the orange. And this is active inventory, so you can see inventory has been coming down in all 3 counties. Offers accepted. It's been going up in all 3 counties. San Mateo is the smallest county, has the least number of offers. Santa Clara and Alameda County have roughly exactly the same number of offers. Days unsold inventory. This is the turnover rate of the marketplace. You can see Alameda County is the slowest at 50 days. That means it's a theoretical number, but basically at the current rate of sales, if there was no new inventory and the rate of sales didn't drop off, you'd sell out your existing inventory in 50 days. San Mateo County is at 39 days, and Santa Clara County is the fastest at 36 days. Here's marketing time for 3 out of 4 sellers to sell. Basically, Santa Clara and San Mateo County are tied. Santa Clara is slightly faster at 25 days. San Mateo is at 26 days, and Alameda County is at 31 days. So for 3 out of 4 sellers in all 3 counties to sell in less than a month, it's still a fairly fast-paced marketplace. You can also see that all 3 counties have been coming down basically for the last 4 weeks. Here's the list price that sellers take, reduction the sellers take before they have the offer accepted. So this is what the seller's doing to bring in the offer themselves. And this is average, so the numbers are pretty small. Alameda County is taking a 1.5% price reduction. Santa Clara and San Mateo County are both taking about a 1.1% price reduction in order to get that offer in the door. They're getting 98.9% of their ask price, so that's a 1.1% price reduction. Here's the frequency of those price reductions. So basically 16% of the sellers are taking a price reduction in San Mateo County, 17% in Santa Clara, and 20% in Alameda County. So only 1 in 5 sellers in the worst county, Alameda, is taking a price reduction. The magnitude of overbidding, you can see Alameda County that had the biggest price reductions is having the most overbidding at 6.5% above the seller's ask price. San Mateo County is next at 4%, which is what Silicon Valley in a blender was overall. And then Santa Clara County is at 3.5% overbid. This is the frequency of overbidding, very close together. It looks like you're about 57% for San Mateo County, 58% for Santa Clara, and 60% for Alameda County as far as frequency. Call it 59% for all 3 counties. That's more than half of the sellers are getting more than their asking price. And you can see historically, that's very true for Silicon Valley. I mean, yeah, there was a period of time right here in 2023 where only 30% of the sellers were getting more than their asking price, but it's rarely at 40% or below, and it's 50% is sort of the bottom line. So it's sort of insane to talk about half the sellers getting more than their asking price, but that's where Silicon Valley normally is. Here's the long-term appreciation. Santa Clara County has done the best appreciation. It's gone up in the last couple of weeks. You're now at about 208% of the price that was in 2015. San Mateo County is next at about 82% appreciation, and Alameda County has seen the least appreciation at something like 63% appreciation. Here's the median sold price. San Mateo County has the highest sold price at about 2.1 million, and Santa Clara County is at about 2 million even. Last week they were only $15,000 apart, and now they're $100,000 apart because of the huge increase in San Mateo County. Alameda County has come down and is about 1,225,000, it looks like. And it's easier to read on this graph, so that does look like it's pretty right. And actually, San Mateo County looks like it's 2,150,000. I was 50,000 low on it. So they're 150,000 apart, not 100,000 apart. They've gone up by a factor of 10. The first was on regular log paper. This is on regular paper. This is estimated payments going through the high balance conforming loan for the national average. You can see the most expensive county is San Mateo at $16,000 a month payment, assuming an 80% loan. The most affordable is Alameda County at about $8,500 a month for payments. Now we're looking at a distribution for the days on market. This is the how long does it take this each listing to sell? So you can see that 50% of the sellers are selling down here in about 16 days. 65% of the sellers are selling in about 20 days. 75% of the sellers are selling in about 30 days. And then 90% of the sellers are selling by 60 days currently. What we do is we step through, we start off a year ago on the dotted line here. We do 1 week at a time for 5 weeks, and then 2 weeks at a time, and then the last 5 weeks are 1 week at a time. So there you can see the market slowing down. Now it's slowing down because you're going 2 weeks at a time, and also the end of the year. That's the slowest, December 27th, a little improvement. Huge improvement, huge improvement, huge improvement, small degradation, small, longer time, slowing down, slowing down. So you can see the run up is very quick and short lived, and then you start slowing down. But what's interesting this week is you'll see we're coming up pretty soon. Right here, I think we have a peak. So we have a peak, and instead of continuing to slow down, it's actually improving. So clearly the market is accelerating and sellers are taking less time to market their property. And that was across all distributions. So you had a broad improvement in the reduction of marketing time. Doing the exact same thing on largest price reductions. The reason I call it the largest is I'm looking at the sellers that are taking 97.5 percentile down to the 82.5 percentile. So I'm only looking at the top portion. Why would I be doing that? Because a year ago, at 82.5% of the sellers, they were taking no price reduction at all. So just looking at lines at the 100% point here, the seller's ask price would really not make up any difference. It's the top end of this graph that does all the movement. So by only looking at 15, the sort of the top 15% downgraded by 2.5% of the market, you can sort of see the trends a lot better. Same concept. We started off a year ago on the dotted line. This year is the purple line. So you can see you're much cooler. You're taking larger price reductions across the whole spectrum. Let's move through here. You can sort of see the bounce. Really not going anywhere last year. So that's what you'd expect this year. And then we're going to slow down. There it is. And there's the slowest for the year. And then it starts heating up rapidly. And there's the hottest for the year, February 21st, right, past Valentine's Day. Now you're cooling off already, and you're continuing to cool off. And let's look at what happens. There's a little bit of an improvement in the market, but not as marked. Let's see if we can notice it. Maybe right from there. Nope, from there. Yep, that's the bottom. Now there's an improvement. There's a little improvement. So there was one big improvement, and then three jumps around. So clearly about 4 weeks ago was the largest price reductions that we were seeing. Doing the same thing now with buyers overbidding. So this is now flipping over and looking at what the buyer's doing and how much competitiveness the buyer sense. because the buyer's not going to overbid a seller's ask price if he or she is not concerned about losing that particular property. Same concept. You can see a year ago on the dotted line, we were higher, closer to the red line than you were on the current purple line, which is close to the blue line. Really not much movement. Also, remember that you need sale price, so you need close of escrow. So this is a lagging indicator. Now you're starting to cool off. You're drifting down, still drifting. There's the bottom of the market. This January 24th. Now there's the peak of the marketplace, March 8th. March 22nd was the same, and so is April the 5th. So we spent 5 weeks up there at the peak. Now you're cooling off, and now you're going to go cooler than it was last year. Right about there is last year's cools. Now you're cooler than last year, but now you're going to turn around. That's the coolest, and look at the improvement. So buyers are sensing the need to be a little bit more competitive, and there's going to be one more jump there. So you've improved from this solid line here to here in a time frame when the market's normally not really moving one direction or another. So something's happening, causing the buyers to feel more competition. Here's a summary of the number of offers. We did 2,209. It's the seventh least number out of the last 10 years. So there's only 3 years that were lower, and they're all right here. 2206 just last year. So we will probably become the eighth slowest year. 1807, we were not going to get down to that level. That was 2023, right after the 2022 price reduction. And then 2022, during the price reduction when we were losing transactions. Here's the raw numbers for Santa Clara County, San Mateo County, and Alameda County, as well as Silicon Valley overall. Noteworthy inventory is down across the board, 3.7% week over week. Active, that's new listings. So the number of new listings coming on the marketplace the last 5 weeks is 3.7% less than it was from 6 weeks ago to 1 week ago. So in 1 week, you've dropped 3.5%. This is total inventory. You can see the range is fairly significant, from a drop of 3.3% in Santa Clara County to only 0.5% in Alameda County. And they're roughly the same size. So those two balance out, and you have a 1.5% overall decrease in inventory. Offers accepted, on the other hand, have actually gone the other direction. Offers accepted have gone up 2.5% overall. Santa Clara County, that saw the drop in inventory, didn't see an increase in offers. Alameda County, that didn't really see that big drop in active inventory, saw an increase. And San Mateo County, that did see a drop, saw the biggest increase at a 5.6% increase in sales. That's pretty significant. Those combined to give a 1.7% drop in days unsold inventory. The biggest drop was in San Mateo County, but it's the smallest county. And then I boxed it off. You can see the median days on market. So half the sellers are selling in this amount of time or less. So across all 3 counties, half the sellers are selling in under 14 days. Their average marketing time, though, is quite a bit higher, somewhere around 25 days. And the time to sell 3 out of 4 sellers is even higher than that, at 25 through 31 days, somewhere around 28 days on average. Then you have all the different numbers here. I have 2 different appreciations. I have the appreciation since 2015, which is the long term, and also the appreciation since 2020 with the pandemic. So you can see since the pandemic, Santa Clara County has appreciated the most at 46%. San Mateo County next at 34.5%, and Alameda County has seen the least appreciation at 22.9%. Now we'll get into the Greater Bay Area. This is 5 regions, 13 counties. The regions are up here for you. Silicon Valley is in the purple. The cities, San Francisco and Marin, is in the orange. South Central Coast, Central Valley, and North Bay. So inventory in all 5 regions is rolled over and going down. So less inventory in all 5 regions. Look at the offers. Offers are going up at a time when offers historically are going down. And they're up significantly in the cities. They're up significantly in the North Bay. And they're up noticeably in Silicon Valley and the Central Valley. So broad brush increase, and even Central Coast, which is pretty stable, is showing an increase. Might call that flat if you weren't seeing your other four regions seeing significant increases. Here's days on sold inventory. So the turnover rate here, a lower number is a faster paced marketplace. Look at the huge improvement in the cities, huge improvement in Central Valley, noticeable improvement in the last 2 weeks in the North Bay, significant improvement in the Central Coast. The area with the least improvement, which is still noticeable, is Silicon Valley. So Silicon Valley is improving, accelerating the least, and it's gone from 55 days down to 42 days. And that's the least improvement. That's huge, folks. Here's marketing time. Marketing time is down a little bit in Santa Clara and Silicon Valley, but look at the huge drop in the city, San Francisco and Marin. I don't know what's happening, but now notice the other three regions are really still climbing. North Bay's rolled over this last week, but everybody else is now, and you might even argue that Central Valley rolled over and is flat, but they're not coming down, which is interesting. Here's price reductions. Look at the increase. Here increasing down payment on decreases is down here. These are big decreases. This would be a no decrease. This would be typical decrease. So Silicon Valley is seeing smaller decreases. Cities is seeing smaller decreases. The other three regions, being the Central Valley, the North Bay, and the Central Coast, are continuing to see larger and larger price reductions. And that doesn't, larger and larger price reductions doesn't mean prices are going down. It means the sellers came on the marketplace too high and have to lower their ask price. What a seller asks for the property doesn't set the marketplace. It's actually the buyer, when they write up the offer and are willing to make those mortgage payments, that sets the price. Here's the frequency of sellers' ask price. So you've been coming down in the cities and in the Silicon Valley in the last several weeks, but notice the other three regions, they're going up. So, you got a tail of, either lagging indicators, and frequency of seller price reductions could be a lagging indicator. These three regions were improving in far as the number of offers. That may take time for sellers to see that improvement and stop taking such frequent price reductions. The fewer sellers will start taking price reductions if more offers start coming in the door. Here's the overbidding in magnitude. So this is how much your buyers are overbidding. Overbidding the most in cities, almost 9% over the seller's ask price, drops down to 5% over the seller's ask price in Silicon Valley. Then the other three regions are actually below the seller's ask price. So they're coming in below the seller's asking price. Probably about 99.9% for North Bay, about 99% for Central Valley, and about 98% or a 2% reduction for the Central Coast. Here's the frequency of overbidding. You can see that the cities in Silicon Valley are tied right around 60%. Cities is probably about 62%, and Silicon Valley is probably about 59%. Then you drop all the way down to a third of the sellers at 34% for North Bay, and less than 28% for North Bay, and Central Coast about 27% of the sellers getting more than their ask price. So it goes from 1 in 4 to 3 out of 5. This is long-term appreciation. The cities is doing the least well. North Bay is the second place worst finisher. Central Coast is at 80% appreciation. Silicon Valley is at about 85, 88%, as well as the Central Valley at about 88% appreciation since the last 9 months of 2015. Here's the sold price. You can see that the cities is getting close to the record high. Silicon Valley is, definitely not at their 2024 peak, nor is it at 2023 peak, 2022 peak. Nobody is at their 2022 peak. The closest found in Central Valley, and that's just because it's so level on the Central Valley. The prices really don't go anywhere in the Central Valley. They have so much land they can can continue to build. Silicon Valley and the cities is basically landlocked. You have only infill projects where you tear something down and build something higher density. Here's the going through what the payments would be. So same order as prices, they all go through the same mathematical formula. And here's the numbers comparing now, this current week, to 1 week ago. So you can see that inventory is down across the board. But I also have 5 weeks ago. So you can see that inventory is actually up from 5 weeks ago in two of the counties in Silicon Valley. Only Santa Clara is down from 5 weeks ago. But you can see I have all 13 counties. I have 5 regions in the bold. I've also added in the Bay Area number because the media talks about the Bay Area real estate marketplace so often. I think it's a completely garbage number, as I do believe that even county numbers are garbage numbers. I think you have to look at the micro markets of similar homes. You can't just blindly go in and group zip codes or look at a zip code. A zip code's too small. You have to group similar behaving zip codes together to get statistically accurate information. And with that, we're open for any questions. I'm not seeing any unmuted mics. So, and here again are the chapters that you can jump to in the YouTube description below of chapters you see most interesting for your own particular endeavors. Thanks for watching. Take care. Bye for now.